In bullion management groups, gold is for real wealth preservation, not speculation. Live webinar with guest speaker David Ransom. And now we'd like to welcome our host, Nick Barisha, President and CEO of Bullion Management Group, Incorporated. Please begin, Mr. Barisha.
Good afternoon. I'd like to thank you for participating in today's webinar. I know this is a busy time for everyone. Today's webinar will begin with a 45-minute presentation by David Ransom, followed with a brief introduction to our new exclusive association with our Alliance Trust by Mark Farmer, our Vice President of Bullion Bars program. After that, we'll open up to a question and answer session. You can submit your questions through the Q&A feature on your screen at any time during the presentation. It is our great privilege to have David Ransom, President and Director of Research of Wainwright Economics, joining us today for this webinar. Wainwright Economics is an investment research and strategy firm which for over 30 years has helped the institutional investment community in devising effective investment strategies through intelligent use of market data and superior understanding of how markets behave over time. David has taught economics at the University of Chicago Graduate School of Business, has been the assistant to former Treasury Secretary William E. Simon. He has provided testimony to a number of congressional committees. His work has appeared in the Wall Street Journal, the New York Times, and various other publications. He holds a master's and a BSc degree from Queen's College, Oxford, and an MBA in finance and a PhD in business economics from the University of Chicago. So it's really my pleasure to introduce to you David Ransom.
Thank you very much, Nick. It's good of you to have me on your show. Well, my presentation is oriented around a whole bunch of illustrations. I'd like to start with the thought that investors are right to pay increasing attention to gold, but I would say its role in the economy and the capital markets is still greatly underappreciated. Some use the price of gold as an indicator of currency depreciation and an inflation warning, but that's controversial, especially in the United States, where the consumer price index is barely moving, and I'll have a lot to say about this later. Investors are also influenced by academics and policymakers. They've long tried to exclude gold from the monetary system, and they continue to deny its economic significance. Many investors also view gold as an investment in its own right, but there are plenty of critics of that too. My thesis will be that gold is legitimate and valuable, both as an economic indicator and as an investment option. So could we move to the first slide, please, Courtney? In recent times, North American investors have lost sight of the connection between the price of gold and the cost of living. And there are several reasons for this unawareness. The main one is simply a short collective memory. So here's the first of my illustrations showing the long-range parallel between gold and consumer prices, all the way back to almost the beginning of the 19th century. The relationship remains intact today, at least in my opinion, but you could see a new and increasing disconnect in the last few years. Reasons for the disconnect include the long time lag that separates market prices like gold from estimates of price levels produced by government statisticians, and the delays are quite particularly long in the United States. The CPI in the US has been re-engineered on many occasions, and these modifications change the speed with which it moves, mostly downward. To portray the CPI, as everyone does, as if it were a single statistic with a history of nearly 200 years, is not technically valid. It would have been better in my chart to show it as a tacking together of a sequence of separate indices, each of which behaves differently. In fact, every time the government has overhauled the CPI, the resulting index has been stickier and less responsive to current events. So that's the picture in the United States, where historically the currency has been stable most of the time. In other countries, especially where currencies are unstable, this parallel between the local currency price of gold and the cost of living is a great deal more apparent. If we could go to the next slide, figure 2 shows the case of Argentina in the post-war period. And during these years, the price of gold rose and the currency fell cumulatively by 13 powers of 10. It'd be hard to find any other country where we could get a larger mathematical number than that. This chart shows a cost of living that more than keeps up with the decline in the currency. A survey of emerging market currencies with various degrees of instability uncovers a neat long-term relationship that encompasses all of them. And that's shown in the next slide, figure 3. It's a pattern of near-perfect proportionality that illustrates one of the major irregularities in all of economics. It's sometimes known as the law of one price. This stipulates that freely changing prices are directly proportional to the performance of the currency in which they're expressed. Inversely, of course. Now, when currencies are stable, this relationship is moot and not visible. The law of one price applies to developed countries to a lesser extent, therefore, because their currencies have been more stable. But it still applies when their currencies are changed. And the next slide, figure 4, shows a similar fit that we had for the emerging countries, in this case for the developed countries, covering the floating exchange rate period from 1972 to the present. The degree of currency change in this sample, of course, is far less than in the last slide. In this time frame, the price of gold has been a moving target. It's especially a moving target today, and there's not yet been enough time for all of these indexes of consumer prices to adjust and catch up. And that's why the slope of a least squares line, I think you can see we've put a least squares line in the graph, the slope is only about 0.75. But if you use longer and longer time frames, you get slopes that are closer and closer to 1.0. So what do we gather from all of this? The evidence makes it plain that inflation, and especially high and variable inflation, is more than anything else a currency phenomenon. Next slide, please. However definitive the evidence, this link between currency depreciation and inflation is playing a relatively small role in the thinking of our current policymakers. Some of them, in fact, are oblivious to it. This is why the media, and ultimately so many investors as well, are confused about what exactly inflation is. Have been using the word inflation up to the moment as the cost of living. But it's useful to think about where a number of other ideas about the nature and the origin of inflation fit in. And some of the most important of these indicators are listed on the next slide. That's figure 5. Although every item in the list has some value as an indicator of inflation, I'm going to argue that all, except the last one, also suffer from serious deficiencies. So let's start with the man on the street, for whom inflation is nothing more than a rise in the cost of living. And think about that. Actually, prices for consumers are only one aspect of the general price level. It's the one we hear most about. But there are other aspects, including wholesale prices, industrial prices, commodity prices, and others. And these different groups of prices don't move in close parallel all the time, because some are much more flexible than others are. It's natural, but it is slightly misleading for government policymakers and the news media to concentrate so much of their attention on consumers, because the other prices in the system could be equally important. It's especially unwise for investors to follow suit and act, for example, as if there is no inflation threat at all when the cost of living index is not rising. It's a mistake where the official index has been engineered to show low inflation, and it's also a mistake where the globalization of consumer good production is forcing slowly consumer prices down. The consumer price inflation rate is a very slow-moving indicator relative to the currency depreciation of which it's a symptom. investors should not make any investment decisions based on it. The second widely watched indicator in my list is a rise in labor costs. I still hear claims that inflation is not an economic problem until the cost of labor is rising rapidly, which is certainly not the case now. But wages have always lagged behind the cost of living, and they can never therefore be a timely indicator of inflation. Not only that, but this time around, globalization is obviously forcing wages down as well. Another quite different definition of inflation is a rapid rise in the money supply. It stands to reason there must be some connection between the value of money and the quantity of money. But this is a bad idea. The reason is that it may be an inverse indicator in practice. If we could look at the next slide, figure 6, you'll see an example. This shows an analysis of MZM, or money of zero maturity, which is a standard measure of cash in circulation in the US economy. In this table, we divided the history of MZM growth into high, intermediate, and low categories, and then we looked at the average inflation rate, measured 2 or 3 different ways in each category. And you see, it's an inverse relationship. We also found that most measures of money in circulation are much more closely correlated with the rate at which the economy is growing than they are with the rising cost of living. Could we go back to the previous slide, please? The next indicator on our list is rising interest rates. Historically, these are correlated with both the dollar's depreciation and the rise in the cost of living. But there are several reasons why they are unreliable inflation indicators, particularly today. One is that central banks are actively involved in manipulating interest rates. They always did, but much more so now, so that rates are not free to reflect market opinion. At times like the present, the exceptionally low level of interest rates doesn't necessarily mean the absence of inflation, but it reflects other Fed concerns such as systemic collapse and the financial condition of the banking system. And even when interest rates are set in a free market, they're always a lagging indicator. In any case, the yield to maturity of a bond is not a measure of actual inflation, it's a measure of expected inflation. So for all these reasons, interest rates have lost whatever power they had in the past to provide a warning of inflation on the way. The next indicator on the list certainly does freely reflect market opinion. It's the shifting performance edge between paper investments like stocks and bonds and physical assets such as real estate and commodities. The general idea is that when physical assets outperform paper assets is a sure sign of inflation. And this is absolutely true. The disadvantage is that different assets perform differently, and some of them are simultaneously being driven by other economic factors. So you can't really pinpoint the inflation rate by looking at these kinds of data. Well, let's sum up so far. We've got many symptoms of inflation, but they may not make good leading indicators for various reasons. Warning of inflation will appear earliest in the dollar's performance as a currency unit. We can express the dollar in terms of several alternative benchmarks: foreign exchange, commodities, precious metals, gold specifically. Currency movements are fast-moving and timely indicators of the dollar,